Thank you, everybody, for attending. I would like to talk about the issue of the use of foreign companies by returning residents and new immigrants into Israel. I think when we look today at the Israeli tax landscape, one of the most interesting phenomena that we find in Israel is this basically tax shelter, which is very broad for people who have made immigration into Israel, who have changed their residence into Israel, especially when we look at people who are not just passive investors, but people which have active businesses and use foreign corporations, which are very lucrative in the Israeli tax area. So I think the first question to ask is, when we talk about new immigrants and veteran returning residents in Israel, is when a person becomes a resident of Israel. Now, the reason this question is interesting is because sometimes people live in Israel for a while before they become resident, or before they think they become resident. Sometimes people think they are residents of Israel, but really they are not residents of Israel. The fact is that residency under Israeli tax law has nothing to do with whether or not you have immigrated into Israel, what your visa status is, whether or not you're an Israeli national. Residency is basically based under Israeli tax law on the Center of Life test. What is this Center of Life test? Basically, the Israeli tax ordinance states that Center of Life is where your home is, where your family is, whether or not you made aliyah into Israel or you became a citizen of Israel, where your economic and business interests are, and where your social ties are. When you look at these five factors, these help determine the Center of Life. There's also what we call a physical presence presumption. What is that? Basically, you count the number of days that an individual spends in certain tax years in Israel, and you may reach a presumption that this person is Israeli resident. However, this is just a presumption. If the number of days spent in Israel is vast, but the Center of Life is outside of Israel, the Center of Life test will prevail. So in Israel, if you spend at least 183 days in a single tax year, or 425 days in 3 consecutive tax years, you will be regarded as an Israeli resident for tax purposes. There are exceptions. For instance, if you just come to Israel to be a student, or a foreign journalist, or for a sports career, or if you just come to do military service, you may spend the requisite number of days and have your Center of Life in Israel, but still you will not be regarded a resident of Israel. A very common case is wealthy individuals who have homes outside of Israel, but have part of their family living in Israel because they are Jewish or for other reasons. And these people often purchase an apartment in Israel and spend a considerable amount of time in Israel. However, under Israeli tax law, they have not changed their Center of Life in Israel because their active business interests are outside of Israel, because of other issues, and this may create a situation, this might create a situation where a person is presumed to be a resident of Israel, but that presumption is rebutted by the individual. However, you should know that the Israeli tax authorities take the position that the earliest of any of the indications here, if your family is here but your business is outside, they view you as an Israeli resident. If your family is outside and your business is outside, but you immigrated, you made aliyah to Israel, they view you as an Israeli resident. However, the courts have repeatedly turned down this position of the Israeli tax authorities. So after a person is first become a resident of Israel, one must check. If this is the first time he became a resident of Israel, then he's entitled to, or she is entitled to, a 10-year exemption from taxes on foreign sourced income. However, if he was previously, or she was previously a resident of Israel, then it needs to be examined whether a sufficient amount of time has elapsed from the date that they previously were a resident of Israel. If this person became a returning resident recently, then after 10 years you obtain the veteran returning resident status. However, in 2007, 8, and 9, it was sufficient to be 5 tax years out of Israel. So let's assume that a person returned to Israel or made immigration to Israel and received this exemption. What does it cover? A lot of people think, and I've met people who live in Israel for years and still think that, great, for 10 years I don't need to pay tax. That's wrong. And that's created a lot of issues for people who came here and have basically buried their head in the sand and believe that they do not need to pay taxes in Israel at all. That's not correct. The truth is, the exemption only covers foreign sourced income. What is foreign sourced income? It's basically income from sources that were produced or accrued outside of Israel or derived from assets abroad. And a person can elect to pay tax on certain income, but to be exempt from tax on other income. So now we know the basic. The exemption applies to foreign sourced income. What is foreign sourced income? Foreign sourced income is basically categorized based on the type of income. It's not just based on where you're getting paid. It's not sufficient to have a bank account and get paid outside of Israel and say this is foreign sourced income. It's not the UK. There's no remittance basis. You need to look on a source by source basis and examine whether or not this income is Israeli sourced or foreign sourced. If the income is business income, the tax law asks, where is the profit generating activity conducted? Where's the business taking place? If the business takes place in Israel, that's Israeli sourced income. If it takes place outside of Israel, that is foreign sourced income. Now, you can understand that this is a terribly difficult question, especially in today's global economy. Where is my business? Is my business in Israel? Or maybe if all my clients are non-Israeli, maybe my business is abroad, but I am personally in Israel. Or maybe if I'm selling in the Philippines products that I buy on eBay from Hong Kong, maybe my business is in Hong Kong and the Philippines. Or maybe it's where my website is registered, or where my servers are located, where my warehouse is. So there are actually no good answers to this question. It's determined on a case-by-case basis. I can tell you that the Israeli tax authorities basically think that it's sufficient that you have several employees in Israel, or even a single employee in Israel, and they will believe that at least part of the business is operating from Israel. Definitely, in my course of business, we are having arguments with the Israeli tax authorities, but this is an open question. Personal services, lawyers, doctors, accountants. Where is the person located? This is a day counting exercise, but the day counting exercise is not straightforward. How many days do you count? Business days, vacation days. It's again not clearly defined. Interest, dividends, and royalties is much simpler. If you're getting paid interest, dividends, and royalties by a non-Israeli corporate body or entity, then that income is foreign source. So obviously it's better to get dividends and royalties than active business income. Rental income is the place where the asset is used. Now let's talk about the title of my talk was Foreign Incorporated Companies. A foreign incorporated company in Israel would basically be deemed an Israeli resident if it's controlled and managed in Israel. Control and management can mean anything from where the board of directors convene to where the active members of the corporation or the strategic organs carry out their decision-making process. There have been court cases in Israel where even if all of the directors are non-Israeli and they have carried out board meetings outside of Israel and there are offices outside of Israel, but the active person in the corporation is Israeli, the company is still deemed to be an Israeli resident, even though it's incorporated outside of Israel. This is why it's difficult today for Israelis to use offshore jurisdictions. However, when you're talking about either veteran returning residents or new residents of Israel, in their 10-year period, in the 10-year exemption period, you will basically not be viewed as an Israeli resident company, even if the control and management is carried out from Israel by a veteran returning resident or by a new immigrant. So we have a new immigrant that lives in Israel that can spend even all 365 days of the year in Israel, who is managing a non-Israeli incorporated corporation wholly and entirely from Israel, and still this corporation is not subject to tax in Israel on its worldwide income because it is not an Israeli resident corporation. It is a foreign corporation. Like any foreign corporation, it will not be subject to tax in Israel unless it generates part of its income in Israel. And this is the tiny gap that the Israeli tax authority officials crept through. A few years after the law was legislated, they started seeing new residents and veteran returning residents use offshore companies and offshore jurisdictions to carry out businesses in Israel. And the argument was, this is not an Israeli company because I am controlling and managing it from Israel. The Israeli authorities understood that there was an issue here. And they said, okay, maybe this is not an Israeli resident company, but I am viewing you as creating a permanent establishment for this company in Israel. And this permanent establishment is like a branch. It needs to be registered for Israeli purposes. It needs to be corporate tax on its income in Israel. The branch is subject to tax even if the company is foreign. And of course the new immigrants are arguing with that. They are saying, no, you gave me these benefits, so I will come to Israel. This is not the correct thing to do at this point, and it's not fair and equal to us that after we already changed our place of residence and came to Israel, you now retroactively subject me to a tax that nowhere in the original legislation anyone discussed. So under this new policy of the Israeli tax authorities that was basically brought to light in tax decisions published in 2015, it was stated that the new resident can create a permanent establishment from Israel, and that the company needs to pay Israeli corporate tax at a rate of approximately 25% on all the income attributed to Israel. Now, not only that, but the Israeli tax authorities stated that the dividends that the company distributed out of the Israeli sourced income would also be subject to tax in the hands of the veteran returning resident. Now, you need to understand this is completely contrary to the law, because the law states that if you're receiving a dividend from a non-Israeli company and you are a veteran returning resident or a new immigrant, a new resident to Israel, this dividend should be exempt from tax. But the tax authorities are basically not following the law, and they are viewing this as aggressive tax planning that they should intrude upon and they should recharacterize as basically turning these non-resident companies into Israeli companies. So let's look at the basic structure that is very common for new immigrants, that many accounting firms and law firms dealing with taxes recommended for people who came in from abroad. I will give you an example. I have a client who had an interpreting business outside of Israel. She was the owner of a company that had a team of interpreters all around the world who were interpreting various languages simultaneously or doing professional translation. A very successful company. This client moved to Israel at the age of 60 because both of her daughters were here. Now, she received advice before she arrived in Israel. It was told to her, instead of using company, a UK company that you use so far, incorporate a company in the BVI in a jurisdiction which does not pay any tax. Pay all your subcontractors, interpreters, and translators from the BVI company. Run it from Israel, control and manage it from Israel. And basically you will not be subject to tax in Israel because you are using a non-Israeli company. Well, my client did exactly that. She came to Israel in 2009, made Aliyah, bought a house in Israel, contributed to the Israeli economy, but then in 2014, she was suddenly audited. And in the audit, even though the law promised her she would not need to report or pay tax on the income of this non-Israeli company, she was asked questions about this company. And at the end of the day, she had to reply to these questions because even though the law provided an exemption from reporting, it did not provide a shield from answering questions asked by the tax authorities. And actually, by Israeli law, all interrogations by the tax authorities must be met with honest and complete answers. And my client was an honest woman. She said, yes, I'm operating this non-Israeli company. I'm operating this non-Israeli business. This is a business that existed before I came to Israel. And this is a business that I received advice that I would not need to pay tax on, neither on the corporate income nor on the dividends. The tax authorities said, well, who is running the company? She said, I am. And they asked, where are you sitting? She said, well, I took an office here in Israel, and I have a few Israeli employees that I recruited as well. And of course, I'm paying many non-Israeli translators, but they're all non-employees. They're contractors and consultants. And the tax authority said, well, looking at this, we believe that 100% of your activity is conducted from Israel, and that you must pay tax on all the dividends you have taken from this company in the last 4 years. So basically, when you look at the same structure, you can come to two different results. If you look at the law, there will be 0% tax on both the corporate income and the dividend income. If you look at the interpretation of the Israeli tax authorities, you are paying 25% tax on the corporate income or on the portion of attributed to Israel. And then you will be paying dividend tax on any dividends you distribute to yourself from Israeli sourced profits. Now these cases are now becoming more and more common. It is not an easy situation. So when a client comes now and asks us, what is the applicable tax rate? We say it's just like rolling the dice. You cannot know where you will be with the Israeli tax authorities. By the way, there's a chance that you will not be audited. And if you are not audited and you are not reporting your income for 10 years, you will not pay tax. But this is not the position of the authorities. And each year, they are trying to legislate an amendment to the original law stating that veteran returning resident and new immigrants will be required to report their income. So they want to take away, retroactively, this exemption from reporting income. Like anything in the tax world, I think that planning ahead of time, when you know what the policy is of the Israeli tax authorities, and you understand how the law is being bent by the authorities to prevent new immigrants and veteran returning residents from exercising their benefits, it would be very wise to plan ahead of time and structure the business in the correct way. First of all, it's important to view whether or not you even became a resident of Israel. Sometimes people think they became a resident of Israel because they got a Taudat Zehut, an ID card, and a passport of Israel, but that's actually not correct. Careful timekeeping must be made of the number of days spent in Israel. If the business interests are outside of Israel, that's important. The use of bank accounts is recommended. If you use foreign bank accounts for your ongoing activity, that's a very important indication that you still have not changed your residence into Israel. If you have a residence outside of Israel, it's important to maintain it, not to sell it. This way, your residence can change, and you can still become a non-Israeli resident, even though you're spending part of your time in Israel. This basically gets you out of the many problems of the Israeli resident and new immigrant status. Second issue is, maybe there are certain transactions that can be conducted before an individual returns to Israel that can create certain non-Israeli or foreign source income streams that are paid out from the foreign corporation that are not basically subject to tax in Israel because they are not part of an active Israeli business. For instance, let's say that there is certain intellectual property held by the individual, or there is goodwill. You can sell this goodwill or license the intellectual property to the company and then create a royalty stream which is not subject to tax in Israel, even though part of the business is Israeli. These, of course, are ideas in the rough, and you need to check them on a case-by-case basis, but these ideas can be very important planning ideas before a person moves into Israel. If you are creating more than one foreign company, which is sometimes a solution to the problem, because, for instance, if you have an active company and a passive company, you can enjoy the benefits from the passive company and not be subject to tax on the active business. But if you use more than one foreign corporation, you must examine whether or not the transactions between the corporations meet the arm's length standard. You know, I'm sure that the previous discussions talked about the BEPS initiative of the OECD. Transfer pricing is currently one of the focus areas of the Israeli tax authority. But still, with careful planning, you can get around the various landmines that the transfer pricing issues give rise to. There are also the non-resident reporting exemptions. It's important that if you move into Israel, you keep a low profile with the tax authorities. Sometimes people, just out of carelessness, create reporting requirements by registering a branch in Israel, by opening offices in Israel. It's easy to get around that. You can incorporate an Israeli subsidiary, you can use subcontractors in Israel, you can retain payroll of a non-Israeli corporation outside of Israel. Sometimes companies will opt to pay a certain tax outside of Israel, Cyprus, for instance, or Malta, in order to have a nexus to where they're paying tax and not claim that the income is completely tax exempt. Of course, you need business purpose and substance for these deals. This is not something that can be done haphazardly. But if you're looking to change residence into Israel and you do have an international business, these are things and issues that you should look at ahead of moving into Israel. The last thing is, I guess, opposite to what I mentioned earlier, is you must make sure that all the appropriate tax forms that you need to file according to your structure are filed. Because I guess the worst thing is to have a careful planning idea or structure implemented, but then for the reporting to be lacking, or to make a mistake with filing forms, thus being exposed to audit by the Israeli tax authorities. If there are any questions, I'll be happy to take them now.
Yeah, just curious, you mentioned the aggressive stance taken by the tax authority on essentially the dividends, which by the letter of the law should be treated as tax-free. I wonder whether this is a challenge in the courts, whether the courts trend in the past.
Well, I'll just repeat the question. The question was, given the aggressive stance of the Israeli tax authorities towards dividends, which is against the letter of the law, is this issue challenged in court or not? The way the Israeli tax system works is that in order for an issue to go to court, it takes a long time, because there first are administrative hearings before the tax authorities. Then there's an internal deliberation within the tax authorities, whether or not a case should be moved for a court to decide, or whether this can be resolved at the tax authority level. In my knowledge, there are currently no court cases dealing with this issue, or at least there have been no verdicts. We have not seen any published verdicts. We have seen that certain private letter rulings issued by the Israeli authorities, the taxpayers have accepted that they need to pay tax on dividends from Israeli sourced income. And I think this is detrimental because once the taxpayer has accepted it, this gives encouragement to the tax authorities who believe that their position is correct. I think that if a good case is brought before the court, especially one with a good factual basis, and it does not look like the non-Israeli resident which moved to Israel has done an artificial or sham transaction by using a non-Israeli company, I think that it has a good chance in court, but of course you never know what a court will rule, and it can definitely take another 2, 3, or 4 years before we get a ruling on this issue. But I definitely anticipate that this will ultimately come before an Israeli tax court. Okay, thank you very much.